My name is Farhan. In this video, you will solve questions 1 to 10 from 2020 Paper 2 Past Exam. Make sure to like and subscribe to my channel, and if you need help with any other topics, post them down in the comments. We're going to start with question number 1 now. Which transaction has a check counterfoil as the source document? Now, the check counterfoil refers to evidence of any payment that has been made to someone outside of the business. So if you check each of the four options that we're given, starting with the first one, check deposited in a business bank account, that doesn't refer to any payment made to someone externally or outside of the business. Check paid to a supplier, yes, that refers to payment that was sent to a supplier using a check. So the check counterfoil in this case serves as the evidence of the payment that has been made to the supplier. Third option says check return due to being out of date. That has nothing to do with payment that has actually been made. And the fourth option mentions dishonored check from a customer. So again, this is not where the business was making any payment, but rather the business expected to receive the payment from a customer, which failed. And none of this serves as the option other than option number B, where the check has been paid to a supplier and the check counterfoil that we should have serves as the evidence of the payment that we have made or sent to our credit supplier. Question number 2. J. Jones received a payment from D. Smith, whose debt had been previously written off as irrecoverable, which is also known as bad debts. What is the correct double entry to record this transaction? So we had this credit customer in the past by the name of D. Smith, who couldn't make the payment back then, and therefore we had to write D. Smith off as an irrecoverable debt. Now D. Smith has come back and has paid us off whatever we had written off in the past. So if D. Smith is paying us, then for the business, the balance available in the bank account should increase, which reflects the increase in assets. And when assets go up, they are debited. So we can cancel out options C and D based on that because we do not have a debit bank, which options A and B have. So which are the two options available for us to select the correct answer from? Then it doesn't make sense to credit D. Smith because when you're crediting D. Smith, it refers to you crediting a trade receivable that is already in the books. But what we can understand is that we have already written up D. Smith and we did not have any expectations to receive this money. So D. Smith was no longer a trade receivable for the business when we received the cash for past sales. Therefore, in this case, we bring something called an irrecoverable debts recovered account, which is what we have to credit in this case. And therefore, the correct option for question number 2 is option A. Moving on to question number 3, what is the correct formula to calculate markup? I'm pretty sure you know this. This is very straightforward and easy. You can also find this on page 33 of the syllabus. It's gross profit divided by cost of goods sold multiplied by 100, and therefore A is the correct option. So if you want to ask me the meaning of markup, so it's simply like what is the additional price that we could add to our cost of acquiring a good and sell it at a profit. For example, think about you running a butcher shop. So you get the beef from the supplier and then you prepare it and then you add some margins on top, which is what we refer to as markup. You add an extra percentage on top and then you sell it for a higher price to your customer. So that is what we refer to as the markup. So gross profit divided by cost of goods sold multiplied by 100. So question number 4, which are all the credit entries in the cost of sales section of an income statement? All right. Now, I need you to understand something here. Cost of sales can be calculated by starting with the opening inventory, then adding purchases, then adding the carriage inwards. Now, carriage inwards refers to the cost of transport of goods into a business, which is obviously part of purchases, and then subtracting any drawings, which refers to withdrawal of any inventory from the business for private or personal use, then we are subtracting return outwards. So we are subtracting return outwards and we are reflecting the fact that we have returned some of the inventory that we have purchased previously from our supplier. And then you subtract the closing inventory, whatever is left on hand at the end of the financial year. And that should give you the total of cost of goods sold, which is also known as the cost of sales. Now, we understand that cost of sales is an expense account by default because it refers to the cost. And because it is an expense account, it should always be debited. This also means that when expenses go up or when cost of goods sold go up, we have to debit it. The question is asking, what are the credit entries in the cost of goods sold section? So the question is asking indirectly, which of these options available reduce the cost of goods sold? So if you check the formula that we just wrote here, anything that has a minus or a subtraction next to it basically reflects a reduction in cost of goods sold and therefore should be the credit entries. So we have drawings, we have return outwards, and then we have closing inventory. And if you check option number C, you can see we have closing inventory, goods for our own use, which refers to the drawings, and then we have return outwards. And that is why option C is the correct choice for question number 4. Moving on now to question number 5. Fred is a sole trader and is converting his business into a private limited company. He will be the only shareholder of the company. Which of the following would be a consequence of this change to ownership status? Now, this is pretty straightforward. So, profits are subject to corporation tax. So, Fred was previously a one person sole trader, and now he has converted his business into a private limited company, which separates himself and the business from each other. What I'm trying to say here is that the business is a separate entity, and Fred is seen as an employee of the business who is also a shareholder of the business or a director of the business. Now, when you change ownership status from sole trader to a private limited company, you're subject to the corporation tax that is applicable for UK citizens. Apart from that, UK citizens and UK companies. Apart from that, because the business, which is a private limited company, is now separate from Fred, Fred has a lot of limited liability. So, therefore, um, now, the limited liability here refers to the fact that the shareholders' personal assets are protected in the event the company faces financial difficulties or any legal problems. So, whatever assets Fred has personally cannot be taken in case the company enters into some trouble or problems. So, the consequence mainly of changing from a sole trader into a private limited company is that he has to pay corporation tax. And this is actually a good thing because when you're a sole trader and if you're making a lot of money over 100,000, you will be paying a significantly higher amount of tax, which is almost half of your income. So that is why you will see a lot of people, they operate as a director or a shareholder from a PTY limited company where the tax rates are reduced significantly. Okay, so moving on to question number 6. Donovan Limited is planning to expand and will require additional finance. Its statement of financial position includes non-current liabilities of 750,000 and equity of 1.3 million. Which method of funding will decrease the capital gearing ratio? All right, so what I've done first is went on to page 33 of the syllabus and got the formula for capital gearing ratio, which is non-current liabilities, NCL for short, divided by share capital plus reserves plus non-current liabilities. Now, the capital gearing ratio is a measurement of the proportion of debt that is available in the capital structure. The question explicitly asked us to find which of these options given here decreases the overall capital gearing ratio. So we're going to start with the first option, which is debenture. Now, debenture is basically a long-term loan which is of a significant value that is given to a company. So debenture refers to debt. So debenture is part of the non-current liability. So if we have more debentures in the business, then the non-current liabilities should increase. And if non-current liabilities increase, the way the formula works is that an increase in the non-current liabilities should increase the overall capital gearing ratio because the numerator, which is the value at the top, should increase. So therefore, it cannot decrease the capital gearing ratio, but rather increase. Same thing goes with long-term bank loan, which also fits the definition of a non-current liability. And if you have an increase in long-term bank loan, it should logically increase the capital gearing ratio because your numerator is going up. Then we have mortgage, which is also again a debt, and that should increase the total non-current liabilities and increase the numerator and therefore increase the capital gearing ratio. So the last option we are left with is ordinary shares. So ordinary shares is part of the equity. So if ordinary shares increase, then the share capital here increases. And if the share capital increases, your entire denominator increases, which means you have to divide more. So if you are dividing more, then the capital gearing ratio should fall. And therefore, the method of funding that should decrease the capital gearing ratio is ordinary shares. If you also want to answer this question from a more simplistic perspective, you see how just a while ago we talked about capital gain ratio being the proportion of debt in the capital structure. So if your proportion of debt increases, capital gearing ratio should go up. If proportion of debt decreases, which is what will happen if you introduce ordinary shares, then the capital gearing ratio should go down. So for question number 6, the correct option is answer D. Question number 7, Ilok runs a sweet shop. He has taken several boxes of chocolates as gifts for friends. So this is referred to inventory withdrawn from the business for private use. And that is what we refer to as drawings. The question is asking, what are the ledger account entries to record these transactions? Now you can see that I've selected two options here. Now, I believe it could be option B and option C. Both of them are correct, but option C is what the marking guide or the mark scheme says. But let me explain you my logic behind why I believe both options should be correct. Now, if some of the items have been withdrawn for private use, that refers to a reduction in the closing inventory balance that should be available on hand. So, which refers to assets going down in this term in for as closing inventories, and if they go down, then they should be credited, and that happens solely because of the drawings, which is debited. And drawings are always debited because drawings reflect a reduction in owner's equity or owner's capital. Capital by default is credit. Because drawings reflect a reduction in owner's capital, we are debiting it. Option C also makes sense in the case that if you're reducing purchases, which is what happens when you credit purchases, I don't think this refers to the supplier obligation or anything in this case because this box of chocolates do not directly refer to purchases because the purchases are a separate account in itself. And whatever amount of inventory is left behind should in fact reflect a reduction in the closing inventory, and therefore the closing inventory should be credited. But that's why I've selected both option B and C. I like to believe option B is correct, but the marking guide says option C as well. But rest assured, I think both make sense in a way. So you shouldn't be too worried about it. So you can select either of option B or C for question number 7. Let's move to question number 8. A business paid £18,250 for wages and salaries during the year ending 31 March 2020. Wages and salaries owing at 1 April 2019 were 2,190 and owing at 31 March 2020 were 2,740. What is the amount to be included for the wages and salaries expense in the income statement for the year ending 31 March 2020? Now, we understand wages and salaries are an expense for the business. Now, here we have a ledger account or a T account that we have created for wages and salaries. We need to understand one thing first. We know that all opening balance of assets are always shown on the debit side, and all opening balance of liabilities are always shown on the credit side, which means if the opening balance of assets are always shown on the debit side of a ledger account, then the closing balance of assets need to be shown on the credit side of a ledger account. And if the opening balance of liabilities are on the credit side of the ledger account, then the closing balance of the liabilities should be on the debit side of the ledger account. Now, I understand it's hard to follow, so I've got something here. Let me share that with you. Just one second, please. Let me share this thing. So I've summarized all of this in a table, which you could look into. Okay, so I believe you should be able to see our screen here. So as you can see, for question number 3 here, you can see the type of account, assets. The opening balance is always on the debit side, closing balance is always on the credit side. If it's a liability, opening balance is on the credit side and closing balance is on the debit side. You can take a screenshot of this or you can just quickly write it down. And if you memorize this, most of the problems will be solved when it comes to preparing stuff for the ledger account. Now I'll be taking you back to the main question. So let's just take you there. All right, so now we are back to the main question. So you understood what was there in the table. All right, so we know that we are working with a business whose financial year started at 1 April 2019 and ended on 31 March 2020. That means whatever we have on 1 April 2019 is the opening balance, and whatever we have on 31 March 2020 is the closing balance. Now, wages and salaries owing at 1 April 2019 were £2,190. You see how it explicitly mentions owing, which refers to wages and salaries being a current liability in this case, which refers to wages and salaries that have been incurred but not yet been paid to your employees. So, since the opening balance is a current liability, and based on what you have just seen in the table, we know that this should be going onto the credit side. So you can see I've written on the credit side of the T account opening balance, which is also balance brought down. It's the same thing. And that is 2,190. You can see it also mentions owing at 31 March 2020 were £2,740. So the closing balance at the end of the financial year also refers to a liability, which therefore means that you need to record this on the debit side as closing balance or balance CD, which is known as balance carried down. It's the same thing, and that is 2,740. Okay. Once we have taken care of the opening balance and the closing balance within the ledger account, let's understand the next thing here. So the first line says a business paid £18,250 for wages and salaries. Paid. It clearly mentions paid. Yeah. So if I was to journalize this first line, journalize, I'm trying to say what is going to be debited and what is going to be credited. What do you think it should be? A business has paid £18,250 for wages and salaries. That means if the business has paid for something, bank needs to be credited, which makes sense because if you're paying for something, then your funds in the bank should go down. And if assets, which are your funds in the bank, goes down, then it has to be credited because it's decreasing. What is being debited here? Wages and salaries. So we are debiting wages and salaries, and we are crediting the bank to reflect the fact that we have used our funds in the bank account to pay for all these wages and expenses. So, since wages and salaries are being debited, that means that within the ledger account itself, on the debit side, because this ledger account belongs to wages and salaries. So on the debit side of this ledger account, you need to show that we have paid wages and salaries using funds in the bank, and that is 18,250. Okay, so once that is taken care of, the requirement of the question is to find how much should we be showing for the income statement. So this is the deficit that we had to derive and calculate ourselves. So how did we do it? We first found the total of everything on the debit side, which is to add the closing balance with the bank balance, and that is 20,990, which fundamentally speaking should also be the same for the credit side. And once you subtract the opening balance, you get 18,800, which is what we refer to as the actual wages and salaries expense for the year. Now, this is transferred as a wages expense to the income statement. Now, you haven't learned closing entries, I believe, and it's part of that concept, but I do not think they covered that explicitly in AQA. But here, the income statement amount that we are calculating refers to the expense that you will be seeing as part of the profit calculation. Like this is the real expense incurred for the current financial year starting 1 April 2019 and ending 31 March 2020. So on that basis, we have selected option C as the correct answer of 80,800. All right, so let's move to question number 9. A business has calculated draft profit for the year ending 30 April 2020 as 43,950. The profit was calculated before the following information had been provided. Wages and salaries of 5,625 were owing at 30 April 2020. So because this is owing, this is what we classify as a current liability. Insurance of 2,175 was paid in advance at 30 April 2020. And because this was paid in advance by the business, this is a current asset for the business because the business is still yet to consume the benefits that comes with the payment of this insurance. Question is asking us to find the final profit for the year ending 30 April 2020 after adjusting for this additional information. We're going to understand things in a different way here. Now, we are at the end of the financial year, so both of this information relevant to wages and salaries and insurance are the closing balances. We understand that. Now, what we understand based on wages and salaries that are owing at 30 April 2020, that's a liability. Why is this a liability for the business? Because this is a present obligation, right? So if this is a present obligation, this means this has increased the expenses for the year, for the business for this financial year, right? So based on what we have been mentioned, that means we have to increase wages and salaries in the books to account for the total expense that have actually been incurred in the year. And the amount of 5,625 being a current liability refers to a present obligation that the business has, or the payment that the business has yet to make to its employees. Then we have insurance paid in advance. So that is a current asset. So that hasn't been consumed in the current financial year ending 30 April 2020. It will be consumed in the next financial year, which means this actually reduces the expenses that we have shown for insurance and therefore should be subtract and therefore shows a reduction here, as you can see with the arrow pointed downwards. Now, if I want to find the revised profit, I started with the draft profit of 43,950, and then I added 5,625. Can you think of why I added 5,625? You see, we know that wages and salaries of 5,625 were owing, which means that expenses should go up. So if expenses go up, profit should go down. So that is why we are subtracting 5,625 to reflect the fact that profit is going down. And then we understand that insurance has been paid in advance, which is a current asset. That means the total insurance expense for the year need to go down. And if expense needs to go down, then profit will go up. That is why we have added this here. So just pure logic and simply subtracting and adding based on the information you were given. So 43,950 being the draft profit minus 5,625 being the expenses that we still owe, plus 2175 relevant to insurance that we have paid for in advance and is not yet an expense. That should give you 40,500 as the correct option to select for question 9, which is option B. So now we're going to move to the last one for this video. So that's question number 10. In the books of Maria, the credit balance on the payables ledger account for Peach Traders is 21,850. So what we understand is that the main business person in the scenario is Maria, and Peach Traders is a credit supplier for the business. And Maria currently owes Peach Traders 21,850. How can we verify that? We know that this is a credit balance on the payables ledger account, and because this is a credit balance, it refers to an obligation, which is also known as a current liability. The following information has not yet been included in the payables ledger account for Peach Traders. All right. So we have interest of £125 charged on a late payment. So because Maria has still not paid Peach Traders is charging an extra amount for the delay, and that means liability should go up. Therefore, if liability goes up, we start with the opening balance, which reflects what Maria originally owed, and then we add an additional 125 to reflect the excess interest that Peach Trader is charging because of the delay that Maria has made in terms of payment. Then we see a contra entry of 580 with the receivables ledger account for Peach Traders. Now, what does a contra entry here simply mean? So and that's 580 in this case. Okay, so Peach Traders, so Maria has been buying all these goods on credit from Peach Traders, and Maria still hasn't made the payment. So let's just say Peach Traders came to Maria's shop and took some items worth 580. And that is what is being offset here. So that is why we are subtracting 580, which reflects a reduction in terms of the balance Maria owes to Peach Traders. And that's how we get 21,395, and therefore the correct option will be option number B.